Hi friends, Simit here from informedtrades.com. In this video, I want to take a basic look at how to evaluate signals and trading funds. Basically, what to consider when you're going to purchase the trading signals through, there are a lot of social trading services out there, or if you're going to invest in trading funds, how to know what to expect and how much money you should put in, whether it's going to be worth it, things like that. A lot of this info is good basic info for just evaluating trading and money management concepts in general, and something that you may want to apply to your own trading. First idea is to identify the annualized cost. If you're purchasing signals or something and it costs $100 or a month or something like that, $50 a month, whatever it may be, know the annualized cost. That's going to determine the amount of pips you need to earn to break even. That's also that annualized cost is really a benchmark or sort of the keystone, the center point that you can base all your other calculations around. Once you know how much it's going to cost you, you have an idea of how many pips you need to earn. You can start looking at average loss per trade based on the amount of pips you need to earn per trade to break even. And you can also evaluate the maximum number of consecutive losses to get an idea of the maximum drawdown you'll incur, and the balance required for running through a set of parameters if you're going to risk 1%, 2%, 3%. And we'll run through an example that'll help make this a lot clearer. Okay, so bkforex.com is a trading service, and we'll just use some of their numbers to go through. Again, I'm using past numbers. They have their trading results posted on their website. I definitely think if you're looking for signals or a fund to invest in, having past results really is something worthwhile. Track record you can evaluate. Now, past results absolutely 100% are not necessarily indicative of the future. Just because someone had a great year last year or a terrible year last year does not necessarily mean the same thing going forward. But it can shed some insight. Certainly, I personally would feel more comfortable with traders who have been consistently profitable for 5 years, 10 years, whatever, than someone who had a short track record, and also the volatility within the track record. If they're up one year and down a lot another year, that can also be something to pay attention to. So past results, not perfect, but definitely something that I think is better than nothing, and I think it does have some value. Okay, so using BK Forex as an example, just to run through, they charge $85 per month if you're an account holder with FXCM for their trading signals. That comes out to $1,020 per year. So that's the amount you need to earn just to break even. With their service, you get books and videos and tutorials and lots of other stuff. We won't factor in the value of that. We're just looking at just the signals. We'll assume that's all added on. So $85 a month comes out to $1,020 per year. That's the amount you need to earn from their signals to break even. Now, their track record, which is posted on their site, from 2008 to 2012, they earned 3,207.69 pips. One caveat is that the majority of that was earned in 2008. So 2008 was a great year. 2009 through 2012, the total for those 3 years was 882.69 pips. Now, I definitely think that you should factor in the outstanding 2008 year, and it also illustrates that if you're a subscriber that holds on for a while, and some of these signals, BK Forex or other traders, are going to have similar types of results. Sometimes, if you're willing to stick on for 4 or 5 years, you can really, 1 year is going to be the really big payout. A lot of trend following systems are going to have that type of dynamic. But the 882.69 pips might be a more conservative number as it reflects the last 3 years, and it's a smaller number. Again, with a lot of these, using more conservative estimates can be to your advantage. You don't want to set expectations too high. If anything, you want to be on the low side. Okay, so they earn 882.69 pips over 3 years. Now, the cost for 3 years is simply 1020 multiplied by 3, which gets us $3,060. So those 882 pips need to translate to at least $3,060 in order to break even, in order to cover the cost, this $85 cost per month. So that comes out to risking about $3.47 per pip. It's actually $3.46 and a fraction. Let's just round it up to $3.47. Call it even $3.50 if you want, to break even. Now, their average loss, which is also posted on their website or their trading results, the average loss for 2012 was 123 pips per trade. So we multiply 123 pips per trade plus the 347 per pips that we realize we need to break even in the long run, and we come out to average loss per trade on the losers is going to be $426.81. Now, the maximum number of consecutive losses that they incurred is 6. Okay, so now we have some key numbers, and we can sort of plug this into a spreadsheet or a framework, and that's what we'll do now. Okay. These two numbers here, the average loss per trade and the maximum numbers of consecutive losses, are what's really required. Now, if you are risking 1% per trade, that's personally something I like to do. It's a conservative measure. You're going to need a required balance of 43,000 because remember, or 42,681, just rounding that up to 43,000 about. That way, if you lose one trade, you'll be out $426. That's 1%. And now if you lose 6 in a row, you'll be down 5.9%. And that is, basically if you're down 43,000 and you lose, one trade, your new starting balance is, 4,261 or $4,260 or something to that effect, and then 1% of that, and you keep. So the short story is that when you lose 6 in a row, it won't actually be 6 times 1 or 6 times 2. It'll be slightly less because each time you're risking a little bit less. Now, on the flip side, when you're winning, you're risking a little bit more if you're using the percentage-based method. Excuse me. But this framework gives you, a rough idea. So you're risking 1%. You need a required balance of 43,000, and the maximum drawdown if they lose 6 in a row is going to be about 6%. 2%, you can start with a much smaller balance, but you're going to have a higher drawdown. And the same concept goes all the way through. If you risk 5% per trade, you can start with $8,600. That's a smaller amount for a lot of individuals, but you will have to be willing to tolerate a much larger drawdown because you're risking 5% of that smaller capital base each time. So if they go through a string of a few losers, and historically they did have a stretch where they lost 6 in a row, that can result in a drawdown of 26.5%. So these are all things you want to think carefully about. What is your risk tolerance? If you're down 20%, you still need to, is that going to shake you psychologically? Or is this capital, if you're an individual who has $8,600 or close to $11,000 that you're comfortable risking and can be a little aggressive with, 4 or 5% might not be that big of a deal. Or might be something that you can handle. Of course, the other factors to consider are your ability to execute the signals. So not only do you have to not be psychologically rattled, but you just have to follow the system and the methodology that they put forth and be willing to execute the signals every single time. Otherwise, you're going to miss out on the winner. That's going to make up for all these losers, and that. So making sure that it fits into your lifestyle is also very important. And with any signal or fund that you subscribe to, I definitely recommend getting to know the people behind it. What you're ultimately doing when you're putting your money in to their method is you're investing, in a way, you're investing in them. You have belief in them for whatever reason. So you really want to make sure that this belief is justified, that it's confident. If you can reach out to them, interact with them through social media outlets, by email, whatever, read their blog posts. In this case, BK Forex, they've got a bunch of videos, they've authored books, they're on CNBC, so you can follow up with them that way, with other signals and other funds. A lot of these people are going to be out there promoting themselves. If they're interested in promoting their business, they should be interested in talking to prospective clients. Calculating this type of spreadsheet can really help you in terms of identifying what to expect. And then how much you can risk, how much you need to put in, and what you can get out of it. Again, I do want to emphasize that this whole spreadsheet was calculated using past results, which I definitely think is worthwhile for this exercise, but it's not going to be 100%. They may have a year where they lose 7 or 8 trades in a row. They may have one where they lose 2 trades in a row. They may have a year where the average loss is less or is more. It's definitely not 100%, but it does give you a framework. It does give you some type of idea of what you may expect based on their past performance, which I think is a worthwhile exercise for any prospective customer to go through. That's about it. If you have any questions, anything you want to add, join us at informedtrades.com. Thanks and best of luck in your trading.